Hello and a very warm welcome to episode 20 of the Money Sign Up podcast. This is the podcast for all things money, all things personal finance for Australians all over the world. Now, we've got a fantastic interview lined up today. We're going to be covering all things corporate tax for business owners, entrepreneurs, with a tax expert here in Singapore. But before we dive into that, just by way of introductions, I'm Jared Brown, based here in Singapore. And joining me is my friend and colleague down in Perth, Joel Kieran. Good day, Joel.
It's good to be back again. And thank you to all of our listeners who continue to support us and listen to us. And we hope that you're finding lots of value out of the podcast.
Absolutely. And looking freezing cold down there, Joel. It's looking grey. It's looking wet. It's looking like somewhere I'm glad I'm not. What is it like in sunny Perth at the moment?
Well, it's definitely not sunny. For the past couple of days now, I think it's gotten to a top of 13 degrees, and it's very much time for me to leave Perth yet again. And I'm done with it. I don't like Australian winter, so I'm done. I'm ready to pack my bags and leave again. Time for holidays.
Well, it's certainly true. The longer you stay in Asia, the weaker you become. And I know it sounds very soft. I mean, we have a lot of European friends and clients and people who will be based in Europe listening to this radio, thinking these guys don't know what real winter is.
Yeah.
But the reality is Australia is just not built for it. Our houses are not insulated, public transport is not heated, buildings are not heated, and especially in Perth, we get that wind right off the coast, and it's just freezing. I had a meeting with some clients in Melbourne last week, and they joined the call. It was about 5:30 p.m. there, in ski jackets. Just absolutely bonkers. And they'd spent a lot of time in Singapore and Hong Kong. So, definitely not used to the cold climates of Australia. But, this is not a weather podcast. So let's dive into the topics of the day. Do you want to give us our usual disclaimer or keep our legal team happy before we dive in?
Standard legal disclaimer there. Yes, of course. So, just I suppose as a friendly reminder, everything in this podcast we use is, a general information only, and you should not be taken into account any of your personal circumstances. So if anything in this podcast that we do discuss at any time, you want to know if that's relevant to you, please reach out to either Jared or myself. We're both licensed financial advisors, and we can provide you with personal financial advice. But yes, thank you so much for continuing to listen to us.
Brilliant. Well, let's dive right in. There's been a lot going on over the last quarter, and really, particularly in the US, obviously it's all eyes on Trump, and particularly the US being very much Western media, very similar to Australia. Mm-hmm. It feels like we've been inundated with just headline after headline after headline. But one of the big things that certainly a lot of Australian expats in the US were watching very closely and are still watching very closely was this one big beautiful bill. Now, it sounds like a wonderful thing. And I guess depending on which side of the fence, you sort of sit and how it impacts you, that will really dictate just how big and beautiful you think it is. But I think one of the big things that, that a lot of people were watching was this remittance tax. The sort of tax that would have applied to money being sent outside of the US by Australians and potentially by everyone else that sat there. But Joel, do you want to just give us a bit of a rundown on, I guess, first iteration and where that landed?
It almost seems a bit like, there's a couple of economies around the world already where it becomes very difficult to, transfer money out of the country. For example, I take China as a key example. It's, quite difficult for Chinese citizens to, just transfer and invest in other markets. And it just seems that, yes, Trump has had this big idea that, if US dollars aren't leaving home and they're not being sent abroad, then they will be spent more in the US. And that will be used as, I suppose, economic stimulation. Now, originally, he'd proposed a 5% remittance tax on all transfers leaving the US. So basically, you were transferring money to family, friends, or even for our Aussie expats that are living in the US, you're transferring money back to Australia to pay your mortgage, to top up your investment account, that was going to be slugged. Additional 5% tax. Now, that can obviously start to equate to a lot of money. Luckily, it was then reduced to 3.5% on all transfers with a bit of negotiation in the Senate. And it has finally sort of landed into the passing of law at 1%. So there's obviously a little bit of wiggle room down for that. So that is now 1% on cash transfers, money orders, and cashier's checks. So if you're making transfers from, let's call it legitimate financial institutions, so US banks, debit, credit cards, or remittance services like Wise, these are the sort of services now that would be exempt from that tax, which is obviously very welcoming as well. So what they're trying to, I'd say the very obvious stab here is the actual cash transfer services like Western Union, or post office transfers, largely used probably by undocumented immigrants in the US. They're going to have this sort of this penalty tax incurred. So it's definitely probably more of it's a driven at that sort of cash society rather than the official electronic means through bank transfers. Mm.
Certainly a big one. And yeah, I mean, I think, gosh, if it had gone through a 5%, 3.5%, I mean, even if 1% had impacted all transfers, just shows the importance of, I mean, not just seeking advice, but really paying attention to where these policies could land and how they could impact you, especially for Aussies in the US, probably more so than any other country around the world, just given how strict the IRS is and how, sort of bluntly these things can be enforced.
Mm. Absolutely. And I saw a statistic, Jared, the other day that, of the potential impact, of who's going to really bear the brunt of this in the US is largely India. So currently, those sort of cash remittance services, the largest flow out of the US, which sits at about $33 billion US dollars for financial year 24, flowed to India. So, it's probably like, where India and these sort of countries that still rely very heavily on a cash society, then, they're still going to be feeling the brunt of this. And, that's going to be definitely additional tax revenue that's going to flow through to the IRS.
Absolutely. So certainly an interesting one. And obviously we've released a few updates on the One Big Beautiful Bill. So definitely check those out if you get a chance. Plenty of other changes there, and not all as big and scary as they could have been, but certainly important to be mindful of. I guess looking a little closer to home, I feel like we don't do a podcast episode without mentioning rate cuts these days, which sometimes we're not talking about them having happened, sometimes just wishfully hoping for the next one. We didn't get the cut in July. As we kind of already mentioned, I think it was about a 93% expectation that we were going to get the cut. The RBA didn't. Now there is a 100% chance or expectation that we're going to rate cut in August. Now that does not mean that there's a 100% guarantee that it does happen. Obviously these things could change, expectations can change. But the latest unemployment data would certainly be supportive of that. What are you sort of hearing on the ground, Joel? I guess, conversations with clients, whether they're looking at refinancing debt, buying property, cash in the bank. What's the sort of general feel, and what are people looking to do?
Look, and I suppose as financial advisors, we're inundated with research and reports that come out, and really, looking back at the reflection as sort of why the RBA didn't cut, I would say is they're looking at a number of things, not just unemployment, not just the way like growth index and CPI. They're looking at overall productivity now. And one of the things that I saw from one of the other economists, very, very seasoned economist, said that, productivity is within businesses is relatively slow, and it's at an all-time low. And that's largely driven because Australia's big companies are drivers of, we love a franking credit, right? So there's so much focus that goes into companies on the ASX paying that dividend rather than holding back that cash and reinvesting and growing the business into, a bigger, scale business. So that's a big portion of difference compared to other economies in the world. Now, when we consider what's happening on the ground here, of course, anyone with debt is like, oh, can we pay less of our debt, please? That would be the nirvana, right? And of course, that's what everyone sort of wants. But there's also a byproduct of debt that's being cut. Obviously, you're going to probably earn less on your savings, and I saw there that it's very swift for the banks to cut the rate on the savings accounts before they cut the rate on the debt. Just that little bit of a margin squeeze there for a couple of days tends to make the banks a lot of money. But overall,
even a week or two, different software, I assume.
Yeah, it's always an answer. But the second it's an increase, let's just delay that, or not delay that, should I say? So ultimately, I foresee that there will probably be a rate cut in August, and anyone with debt, it's always timely to review that, because if you're with a bank or an institution that is not going to pass on the full rate cut, they want to start to claw back some of that margin, you'll probably see a full rate cut from the big four. But some of the other smaller banks that already have very slim margins, this could be an opportunity for them. So it's just probably a watch out opportunity for if you've got debt with probably not one of the big four, or even if one of the big four are not passing on the full rate cut when that eventually does happen.
Most definitely. Yeah, always a good time to review the debt whenever there's a change in rates, and just make sure you're on the best possible rate. Reach out to your advisor, your broker, and even explore borrowing capacity. Can you access equity? You're looking to expand portfolios further, whatever it may be. Always a good idea, or a bit of a kicker to go and get that sort of debt health check carried out.
And I suppose more or less planning for the long-term strategy for each of us. As debt starts to become very cheap, there is obviously a lot more that we could be proactive with things like equity and debt as well. So just a consideration.
Absolutely. Well, look, we might dive straight into our interview today. Now, I mentioned at the start of the podcast, we've got a bit of a tax expert here in Singapore. We are always inundated with questions around how do we pay less tax? What are corporate structuring options in Singapore? Can we just come over and set up a business and just park all our profits in there and never pay tax in Australia again? If only it were that simple. But Singapore is very much pro-business. So for anyone thinking about starting a business, wondering what it could be like to run a business here in Singapore, I'm sure you'll get a lot of value out of the interview. So let's cross straight to our chat with Boon and see what he's got to say. All right, a very warm welcome to our guest today. For today's interview, we're absolutely delighted to have one of Singapore's renowned tax experts join us, Boon Tan of CST Tax. Boon, huge thank you for joining us and giving us your time today.
My pleasure. Thank you for inviting me.
Now, Boon and I, we've known each other for, I want to say, 7 or 8 years.
It's closer to 10, I think.
Close. Oh, there you go. Okay.
10. Yeah.
Making me feel old.
Yeah.
I know we recorded a session, in our boardroom about 6 or 7 years ago on how Singapore's tax system works. And so, obviously delighted today. We're going to dive into a lot of in-depth information for businesses, business owners, want-to-be entrepreneurs, people thinking about starting their own business. I think a lot of people hear about Singapore's tax rates who might be living in Singapore and think, gee, wouldn't that be nice? But very few people actually have the understanding and the sort of in-depth knowledge of how it all works together. So we're going to unpack a lot today. We're going to dive in. We've got plenty to uncover. So let's just dive straight in. So
Fantastic.
I guess first and foremost, let's start with, why this is actually relevant. So if I or Joel or somebody listening to this podcast is running a business in Australia, let's say it's a professional services business or something online, and they're thinking, I'm really getting sick of paying all this tax, all this red tape. Maybe I could just go and set this up in Singapore. What are some of the main reasons that you see in the people that you're dealing with that they decide to actually shift a business or even just start a new business in Singapore?
Yeah, good question, Jared. So often people are looking to find a new market for their product and services. They're well established. They're a mature business and effectively have hit a point in their journey in Australia where sales are perhaps not growing as quickly or as large as they want. Other options and other reasons where my clients and people I talk to think about Singapore is often where a client says, hey, we are about to expand ourselves into Asia. Would love to have you help us in Singapore. Are you there? No, we're not, but you're one of my bigger clients, so let's have a look at it. So there's there, and other reasons are also personal lifestyle reasons as well. Some people might say, forget about, put aside tax rates and things like that for the moment. It's just too cold. I want to go somewhere nice and warm. Let's move as a family up to Singapore and start something fresh and new and exciting. So there's a lot of different reasons why I'm seeing people wanting to set up business in Singapore. But the key fundamental question is always, in terms of when I provide advice and guidance, is understanding why. What is the real driving factor? What is the key? May not just be one, might be a few, but let's learn and understand why you want to do this, because it's very easy. Singapore at a macro level is very pro-business. So it's very easy to set up and start a business in Singapore. But if you've made a mistake or actually maybe I'm not quite ready for this, it's a painful process to close it and costly as well. So all these things need to be considered, and finding the right advisor based in Singapore who knows the ins and outs is really important first step in that journey.
Mm. I think the weather is a very timely one, given, as at the time of recording this, it's the late July. So all of our Australian listeners, and including Joel himself, freezing cold down in Perth at the moment. And I know I try and avoid Australia at this time of the year. My blood is way too thin. I've been in Singapore nearly 13 years, and I have zero interest in experiencing Australian winter, especially in Perth. We get all the wind off the coast. Now, Boon, you touched on some really interesting drivers, I guess, as to why people might consider moving to Singapore. What about the actual structures of the business themselves? And maybe, let's take that a step further if we can. And if you could talk through not just the structure of the entity they may look to set up in Singapore, but even the shareholding structure that sits behind that and what people might want to think about at a high level.
Sure, yeah. So structuring for a company in Singapore is quite important, because there are a number of key reasons which you need to consider when you make a decision on how do we own the shares. A key one is, in Australia, we're all very used to, companies being owned by family trusts, for example, right? And that's the family company is owned by a discretionary family trust, and every year the profits we distribute amongst the family group. Now in Singapore, that a different approach needs to be considered, because in Singapore, individuals aren't taxed on investment income. So it might be that, hey, we actually want to own these shares directly ourselves if we're going to move to Singapore. Let's caveat on that situation. So if you're a individual tax resident of Singapore, you're not taxed on investment income. So if you own the shares in a Singapore company, you have the ability of paying yourself dividends, and none of that is taxable Now, that's fundamentally different to what it is in Australia, where dividends, after-tax dividends, are then taxed again at the individual level. So that's point number one. Point number two, and the second key attribute, is there's no capital gains tax in Singapore. So again, if you're an individual and you own the shares, in the event that you sell the company at some point in the future for a profit and you're a tax resident of Singapore, you're not taxed on any of that profit that you make on the shares. Now, it may be, conversely, or compare that to if you had the family trust in Australia owning the asset, the shares in the Singapore company, what you're then doing is effectively potentially putting it in a taxable environment where the Australian tax might say, okay, well, the trust has this income, Australia taxes on worldwide sources of income. Therefore, instead of a zero tax environment in Singapore, you've now artificially created or inadvertently created a tax nexus with Australia because the family trust in Australia owns the shares. Now, they're the tax attributes, but again, fundamental to how we structure, and this is a point, regardless of whether it's a Singapore company, Australian company, any company, depending on the risk appetite or risk exposure of the shareholder, maybe we do want to put it into a structure and instead of an individual. Often you'll find that, entrepreneurs will say, look, potentially if something goes wrong, I might get sued, and I don't really want the nest egg, which is the value of this company in my personal name. Is there a way to protect it? So tax is obviously a key fundamental element to consider, but it should never be the driver, right? There are other key fundamental business, commercial, risk management matters that need to be considered as well.
Oh, Boon, when you're talking about tax not being the driver, hearing no tax on investment income or capital gains tax, that just makes me cry in Australian tax residency.
Absolutely. No, for sure.
Yeah.
For sure. So, and I think there's a few other key elements to consider is also where there's tax exemptions which apply to newly incorporated companies, where a certain proportion of the first 200 of taxable income for the first 3 financial years is effectively exempt. And one of the requirements for a company in Singapore to access this exemption is to have at least 10% held in the name of an individual. So again, subject to what kind of operations and expected forecasts you have for profit in Singapore, that's also another issue that needs to be considered. Often, as we all know, startups don't necessarily have 200 of net taxable profit in the first year because we're just entering a new market. We don't have any existing clients. But if you're moving a existing business and relocating the HQ from Australia to Singapore, then potentially that's something to consider that for the first 3 years we can take advantage of. And if that individual happens to be a tax resident of Singapore and remains one after the 3 years, then potentially an option is then to go, okay, well, we've utilized that concession now for the 3 years. We never really wanted any shares in the individual name. Let's transfer those shares into the structure that we actually want. Again, there's no capital gains tax. There is a small stamp duty on transfer, but that's only 0.2%. So it's effectively a costless exercise to, get the concessions for the first 3 years and then in year 4 restructure so that, okay, now going forward, we have the actual structure we've always intended for.
it definitely sounds like Singapore just generally is it's very focused on driving new business, new innovation, like particularly with particular tax strategies such as this. While I suppose we're talking then about tax strategies and I suppose just more broadly, Boon, could you talk through sort of how does Singapore's corporate tax system work? It just seems like there's no tax at all to be quite frank from my view here. And so what does that look like? What does Singapore's corporate tax system look like? What's the current rates? And really, how does that compare globally?
Sure. So Singapore's current headline tax rate is 17%. So, which is, quite low when you look at a global comparison. Australia, as we know, is 30%. The UK is 22%. Indonesia is 22%. So 17% is quite a low rate for a corporate tax system. Now, the key element is that the effective rate is slightly lower than that because of the fact that there are these statutory concessions to exempt some of the income. But generally speaking, the Singapore corporate tax system is very straightforward. And Joe, I think the key context to share with our listeners is that if you think about Singapore, if you've never been to Singapore before, it's an island country. So there's not a lot of natural resources. So in terms of much driven by professional services, hence Singapore's a big financial hub in the world, the ports, logistics hub, and then airports, aerospace. Changi is one of the busiest airports in the world. So all these human capital focused industries are what Singapore relies on to build its economy. And it's in that context that you need to that you can then appreciate, understand, okay, so that's why Singapore is pro-business, right? Because the more companies and businesses that they can attract to set up in Singapore, the more opportunities there's going to be for their citizens to get jobs, innovation, general economic activity. So when it comes to corporate taxation, it is very, in terms of calculating your net taxable income, it's very much similar to any other jurisdiction. My gross sales less expenses, net profit, that's taxed at 17%. Oh, pardon me, that's then reduced by those statutory exemptions we talked about, and then your tax at 17%. And that's why, because of those statutory exemptions, the effective rate is not really 17%. It's slightly lower, closer to 15, really. Oh. Now, I know that from an international tax perspective, obviously the OECD are looking at standardizing a minimum tax rate of 15% for corporations globally. So Singapore's kind of teetering on the edge or getting very close to that threshold. But I think, but it does recognize and has taken steps to sign up and implement policy to adhere to those BEPS programs and strategies that the OECD are rolling out. So Singapore is very cognizant of its place in the global economy, and certainly if the mainstream approach is, hey, 15% is the base rate, Singapore will ensure that they meet and comply with that, while still have the opportunity and the policies available to companies to support companies that are in key industries that they would like to have here on the islands.
And I suppose in comparison, what do you see as sort of any sort of common tax mistakes that you see Australian businesses when they're first arriving in Singapore? Is that adhering to that company tax policy? Is there any other common mistakes that Australian businesses are making when they first arrive?
Yeah, great question, Joel. And the answer is yes, absolutely. And it's not just in tax; it's in everything. Um, yeah, a key misconception or something I see quite a lot of is, Singapore and Australia are both Commonwealth countries. They operate under common law. The Tax Act is modeled on the UK Act. So therefore, this is going to be a walk in the park. What we do in Australia, I can just walk into Singapore and apply it. Let me give you an example. So in Singapore, and it's back to that, context of pro-business. So GST, something we're very familiar with in Australia. I think from memory, the threshold to register for GST is something like 75,000 Aussie dollars.
Correct.
Okay.
Correct.
Yeah. So it's a pretty low threshold. If you're a real bona fide business and you want to be successful, you're definitely going to hit that threshold, right? Now in Singapore, conversely in Singapore, the threshold is $1 million sales per year. Now, why is it $1 million? It's $1 million because my government's policy is I do not want to burden you with GST compliance unless I'm comfortable that you've got the resources to meet your obligations. Okay. Because, whilst Singapore gives you a very flexible, rather inverted commas, relaxed runway to do business, it is very strict on compliance. So if you're late for filing, okay, you'll get fined. If you miss a filing obligation and you're recalcitrant or continue to do it, it is potentially a criminal offense. So to give you an example where people get it wrong, I'm going to use a Australian company which actually brought out a former US president to do a presentation or talk in Singapore. This was pre-pandemic, about 2018. Sydney found a company. They had set up a company in Singapore with another service provider, and they were trying to register for GST. Now, if you do not meet the $1 million threshold, okay, in the sense that if you're a new company, so therefore you don't have any turnover, you can apply for GST, but it's on a voluntary basis. But unlike the Australian system where we can say, hey, we would like to register from this date forward, bless you, Singapore actually needs to approve the registration. So it is quite a process to go through, explain to the tax authorities why you want to be registered, what is the basis. Now, because Australia has that flexibility to effectively pick the date you want to register from, they just went forward and started charging GST on the tickets for the event. Now, the issue is, whilst you put in the application, the tax authorities will pick the date that you will approve for registration, and it won't be retrospective. Okay, so you might say, we want to start trading from the 1st of August. But if the tax authorities don't approve your registration until the 23rd of August, that's the date that you're going to start being registered for GST. So any charging of GST before that point in time is actually illegal, all right, because you're not registered. So when I picked up or got introduced to the client, because I had a relationship with the Australian accountant, even the Australian accountant was, but we can retrospectively register for GST. And I said, well, I get that, and I know that from Australia, but that doesn't work that way in Singapore. Why doesn't it? What do you mean, why doesn't it? Like, it's just the rule here. And you fundamentally, our client has fundamentally broken the law on the first attempt of doing business in Singapore. So that's a very extreme example, and we're talking about, ticket sales of a couple of $1 million. I mean, they would have been able to register, but the fact that they charged the GST before registration, the tax authorities somewhat went, we're actually not worried about your registration request. We're more worried about your contravention of the GST law by charging GST before you're registered. So let's not worry about your registration for now. Let's talk about what you need to do to rectify this breach of the law. Another example for another client, and as I said, and this one's not tax related, was that they wanted to use a Australian employment agreement for a Singapore employee. Now, their rationale was this employee in Singapore used to work for us in Australia. One of the reasons we've set up the company and expanded into Singapore is because this trusted employee has moved back to Singapore. We're just going to use the employment agreement we use in Australia. In fact, he's even going to work on the Australian public holidays. And, it took a number of times for us to say, well, that's not actually kosher and that's not going to work in Singapore. And if the employee wanted to, even though it's not a public holiday in Australia, he's got every right to take the day off if it's a public holiday in Singapore, and legally you've got no leg to stand on. So, they're two very different but key examples of where businesses sometimes get it wrong and really don't get the right advice before they start dipping their toe into the market in Singapore.
Just so important to, as you say, to have the right team, the right advisors around you to tell you these things, because you might consider the tax or you might consider GST or one figure and then miss just, so much else that could seriously impact things. But one of the other, I guess, common scenarios and common questions that I certainly get asked here is, business owners in Australia, can I just set up an entity in Singapore and shift all the profits there and not pay any tax? And various forms of that question, but really along the same lines. Could you talk to us a bit about transfer pricing, and I guess maybe a bit about what somebody needs to think about in perhaps running a business that does exist in both jurisdictions?
Yeah, great question, Jared. And I think before we worry about transfer pricing, a key fundamental question is corporate tax residency. In Singapore, corporate residency is not determined by merely where the company is incorporated. So you can prima facie, you can incorporate the Singapore company under the Singapore Companies Act, and it won't be regarded as a tax resident of Singapore. Now, that's quite different to a lot of other jurisdictions, but again, the fundamental context is Singapore just wants to make it easy to do business. So, and you'll find that in life in general, and Jared, you know this very well, when it comes to rules and laws in Singapore, it is very much black and white, right? It's not about, how to interpret this, no, it's, are you on this side of the line or are you on that side of the line? So for a corporate resident of Singapore to exist, what the test is not where the office is, the test is not who the shareholders are and where do they live, it's where do the directors of the board meet. And as long as they physically meet in Singapore for the appropriate amount of time each year, that will meet the criteria to be regarded as a tax resident of Singapore, because the test is on a strategic commercial level, which is at the board of directors. Now, that's a very simple definition, right? Again, by design, but that's very different to the Australian definition where, a company can be a resident of Australia by the mere fact that there are people running the business from Australia. Now, they don't need to be directors. They don't need to be shareholders. They could be the bookkeeper processing payments online with one of the Singapore banks, but they're sitting in Perth. So so before we even worry about how do we manage tax issues, the question becomes, have you been advised appropriately and understand what it means to be a corporate tax resident of Singapore and a corporate tax resident of Australia? Because in most cases, unless you have an office, a staffed office that is more than just a hot desk in a co-working space, employees who are more than just the marketing or clerical officer, but someone that has fundamental authority and power to run the company independently of Australia, more likely than not, it will still remain a tax resident of Australia. So you would then have your Australian business in your Australian company and a Singapore business in a Singapore company, both needing to pay tax in Australia because they both meet the criteria to be residents of Australia. Now, some people will say, well, maybe, it goes back to the commercial point. Well, we want optically to look like we're a Singapore-based company. That's fine. And if that's what you want to do, that's fine. But obviously, just because you're a non-resident for tax purposes in Singapore doesn't preclude you from your annual compliance obligations. And in Singapore, compliance obligations are materially different to what they are in Australia. So when a company does a set of financial statements, and I use the word financial statements deliberately, it's more than just the P&L and the balance sheet and the director's declaration, right? A simple set of financial statements for a Singapore company is no less than 15 pages. For operating companies, it can go up to 30 or 40 pages. Now, from an Australian perspective, that is generally only seen in listed companies or large private companies. But the reason is that in Singapore, every company needs to prepare statutory financial statements, which are in accordance with Singapore accounting standards. Now, that's a balance sheet, profit and loss, cash flow, note, risk assessment, director's report. So, as you can appreciate, the cost of compliance in Singapore can be and usually is materially higher than what they are in Australia. So if you don't get it right and you are not saving the tax you think you're going to save by setting up the company, you've not only exposed a Singapore company to Australian rates of corporate tax, but you then also incur the reporting and compliance costs and obligations that a Singapore company has. So it's really important to be cognizant and mindful of these differences as part of your journey at the start, so that you can make decisions like, okay, we actually, understand that. Great. Now, is it a case of employing someone in Singapore? Do we know anyone who's already in Singapore that we know, like, and trust, that we can delegate authority to run the new office? Or do we need to, do we ourselves as business owners need to relocate? Or is there someone in the Australian business that we can have a chat to and say, look, we'd like you to go and open the office in Singapore, move your family, we'll support you. Again, these are all costs that if you don't think about and plan early on is going to cost you more than you imagine, really.
Certainly a lot to be thinking about there, and yeah, obviously double tax agreements, various things come into play there. But yeah, I think not enough people consider the actual corporate tax residency and the requirements there. I think a lot of people get caught up, and I'm sure you must hear it all the time, 183 days, and that's all that matters, and it's just about the individual, and therefore everything else is irrelevant. which is, certainly very clearly not the case. What
Yeah.
about, let's assume that the business owner or business owners have received great advice. They're working with yourselves. They've got a great team around them. They've set up properly. Now they've got an entity that exists in Singapore. They've got an entity that exists correctly as it should in Australia, complying with everything it needs to. How do businesses, and whether it's sort of some examples or what flexibility perhaps business owners may have in terms of shifting, redirecting where revenue is realized between those two countries?
Yeah, good question. There are a number of different ways to repatriate profits from Singapore back to Australia. So, if the Australian company is the shareholder of the Singapore company, if the Australian company is the shareholder of the Singapore company, then a very simple approach is to declare a dividend. So in Singapore, dividends paid to non-residents don't incur any additional tax. So there's no withholding tax charged in Singapore if you pay dividends to foreign shareholders. Now, the issue that arises on that is that it therefore means that if that income is taxable in the foreign jurisdiction, which it would be in Australia, there's no credit for the tax paid in Singapore. So therefore, it may not be the most cost-effective approach to repatriate profits. So therefore, you need to think about other ways such as management fees, royalties, perhaps interest on loans. But again, these interest on loans, royalties, and certain management fees can incur withholding tax as well in Singapore. Now, the double tax agreement comes into play to reduce that rate or provide a concessional rate. But again, these are all things that need to be considered, forecasted, mapped out. And returning to the transfer pricing issue, any transfer of profit or income from Singapore to Australia, the transfer pricing principles must always apply, which is it an arm's length rate? Is it commercial? Are you able to demonstrate a real service being provided by Australia to Singapore to justify not only the charging of the fee, but the level of fees being charged? Do you need a transfer pricing report to be prepared and submitted to the tax authorities in Singapore and Australia? Now, again, thankfully in Singapore, that reporting threshold is a lot higher than it is in Australia. Again, we're, back to the fundamental concept of not overburdening business. But regardless of the fact of whether you need to do that report for Singapore, it is still important to have a commercial, rational, and supported basis for charging a fee to extract income or profits from Singapore back to Australia.
Yeah. So as well, I'm just starting to think about, Boon, we've spoken quite heavily about, the sort of inception and running of a corporate entity in Singapore. What about, let's just throw that onto the sort of flip side of the coin here, closing it down, right? We've got potentially a company that's been in operation in Singapore for quite some time. What does that look like in order to wrap it up? And, what happens if, business owners or directors or the board decide that, hey, we now have to leave Singapore, and is there much point in keeping the company anymore? What does that sort of closing down, leaving Singapore tax situation look like?
Yeah, great question, Joel. Let me go on this journey with you this way. Setting up a company is actually very easy in Singapore. Once you Once, assuming that your name is approved, and that's another quirk that a lot of people in Australia might need to get their head wrapped around. If you've got a unusual name, it may require a few days for you to proceed with the incorporation, because the name would need, all names need to be approved by APRA, which is the equivalent to ASIC in Australia. So in Singapore, APRA always and must approve all company names before you can proceed with the incorporation. But assuming you've ticked that box, incorporation really only takes 2 or 3 days. It's very simple. Very similar to Australia. Now, closing a company, on the other hand, can be anything from 6 months to a year, subject to how you want to do it. There are, again, common law country. Obviously, the options are liquidation, administration, getting an insolvency specialist to go through that process, right? If the company is large enough to warrant that. But even a simple, as you said, Joel, we just got to get out. Everyone's leaving. Let's just shut the company down. Deregistration is really a 4 to 6 months process. Okay. And to do that process, you need to do a final tax return, get tax clearance from IRS to say, we're happy that this company now has met all its tax obligations for life, effectively. You then need to ensure that the net assets of the company are no more than 1,000 Sing dollars. Okay, so whether that's forgiving loans, repaying loans, declaring and paying dividends if there are retained profits. But once you get that down to 1,000, then you can put in an application to APRA to deregister the company. And then it goes through a process of review. Once APRA approves it, it would then get gazetted in the newspaper to effectively alert the public that we've received an application to deregister this company. Please let us know in the next 60 to 90 days, depending on what the company does, whether there's any objections. And then once that period ends, then goes back onto the conveyor belt in APRA to go through the red tape. And then 6 months later, you get the letter saying we've officially struck it off, right? So go back to the start. One of the key things I always talk to my clients about is, well, yeah, look, sounds good. We're delighted to help set you up and join you on this journey. What's your exit idea? What's your exit? Right? Obviously, you always go into these opportunities with a positive mindset. But if it fails, you should realize that you can't just walk away. Okay. It's not going to be a quick process to wind it up. There's 6 months. And during that 6 months period, you still need to have costs relating to a company secretary, costs relating to potentially a local director. And I'll come back to those 2 points shortly. But, it's not as simple as, okay, where do I sign? We're going to shut this down. It'll be done in no, right? So going back to the local director, company secretary, every company in Singapore needs to have at least one director who ordinarily resides in Singapore. Now, that individual is usually a permanent resident or a citizen or an employee who is sponsored on an employment pass for that company. Now, if you're shutting down the company, until it's shut down, until ACRA formally says we've deregistered, that company is still alive, and therefore you need to meet those conditions. So even though you're shutting down, you're not doing any trade, your company secretary, which is a licensed and regulated position in Singapore, will be charging you fees to maintain that position until deregistration. Same with the local director. Okay, so again, shutting down is potentially not a cheap process. Even if you're a simple company that hasn't done a lot, there are still these trailing expenses that you need to be conscious of to factor in when you're making the decision, or to factor in to allocate the appropriate budget for the process.
Yeah, no, of course, definitely. It seems definitely much more convoluted than what Australia is. And I just sort of thought, when you were talking about, the tax authority of Singapore, IRAS, sort of is there any sort of big red flags that IRS will bring up in running your corporation, or closing it down, or setting it up? I sort of get the image, and I know definitely in Australia, the ATO is not someone you generally like to get a red letter from, because that means they've already made a determination. Somehow now you've got to prove them wrong. Um, is that the same with IRAS? What's sort of any key, red flags, warning signs that are going to come from IRAS?
Yeah, look, I think generally speaking, if you meet your compliance obligations, you don't charge GST when you're not officially registered, you lodge your tax return on time, you pay your liabilities as and when they're due, IRS will pretty much leave you alone, right? There are certain areas of focus, okay? And obviously a big one is international sales, international income, and understanding or confirming that, okay, you say you've generated sales from foreign sales, which you say are not taxable in Singapore. The number is material. We'd like to understand why you say that. Now, to explain why foreign income may not be taxable in Singapore, a key element to note is that Singapore actually only taxes Singapore-sourced income. So it's not like Australia, the UK, or the USA, where it's worldwide income. Okay, Singapore basically said we will only tax you on Singapore-sourced income. Now, sourcing is not a defined area. It is common law, based on common law and judgments of court. But basically, the approach is, if work is done outside of Singapore to generate the income, it is prima facie foreign income. Now, IRAS may, and it's something that I've experienced more recently in probably the last 6 to 8 months, IRAS is certainly looking at this area of foreign sourced income and asking questions about, okay, how is that income generated? Like, take me through the process of the sale, contract signing, etc. And fundamentally, what I've found is that IRAS generally views that if you're a Singapore company and you've entered a sales agreement with a customer, even if it's someone based outside of Singapore and you have a team or a branch office doing that service, we will still say it's sourced in Singapore because it's in an engagement with a Singapore company. Okay. Now, we won't. We will go into the chapter and verse as to whether fundamentally I think or agree with that. That's just reality, right? But generally, most of the time, IRS will not look at a company if you're doing the right thing. Now, if it's not they may look at press articles and media reports, but generally their approach to compliance is very different to what it is with the ATO. Okay. But I think you would appreciate that because of the policy and the way the tax system is structured in Singapore, it doesn't really lend itself to a lot of manipulation. For one of it's a lot of people are just happy to comply, and then I declare a dividend to myself, and that's tax free. Off we go, right? Let's keep going because Singapore is so business friendly that there's really no need to rock the boat in any way.
As you say, Singapore is very pro-business, and I heard Tax put beautifully the other day that tax is a success fee, which I think we can probably all agree with. But it's a hell of a lot better when that success fee is only 17% or zero in the form of a tax-free dividend. So I don't think anyone would be complaining too much about that. And but I guess a couple of final questions, if we may. One common scenario, and feel free to dive into this as much as you wish. But one common scenario or common question that we get asked, particularly by Australian expats who've maybe been living, working in Singapore for a while, maybe they've invested in their mate's startup, maybe they've got some shares in their employer that still exists in Singapore, and they're thinking, you know what, I don't really want to go back and pay tax on these, but I also can't liquidate or don't want to liquidate them just yet. So one thing that a lot of people seem to explore is, well, can I just set up an entity in Singapore that becomes my sort of investment holding company, chuck those shares in there, go back to Australia, and if all works out, I'll move back to Singapore in 10 years' time, take it out as a tax-free dividend, happy days, and on and on we'll go with our few $1 million on our boat in the Mediterranean somewhere. Could you maybe dive into a little bit of that as much as you wish?
Yeah, that's a very interesting strategy. Haven't heard that one for a while. But I think it goes back to an earlier discussion we had about corporate tax residency and the fact that, okay, you can set up your Singapore company and if you have permission from your employer or your mate to transfer the shares across, unless you actually make that Singapore company a bona fide tax resident of Singapore, okay? And potentially there are other rules such as the CFC rules in Australia, which would even prevent you being a shareholder of that company. It's going to be very hard for you to just set up a company, transfer it, and then forget about it. Right? The CFC rules on their own, forget about tax residency for a minute, because you can get directors in Singapore. You can pay nominally directors in Singapore so that it looks like, well, there's no Australian directors. Yeah, that's fine. But this is a investment holding company, and the CFC laws provisions in Australia fundamentally target these kinds of arrangements. So as my colleague from Sydney, Matthew, who I know has been on this podcast before, would say, you're going to get that income's going to get attributed to you anyway. So it's not the solution there. And let's not forget that often, if you are when you leave Singapore as an individual, there is this concept of exit tax, and if those shares happen to be shares that you've received as a employee under employee share scheme, then when you leave, even though they're not actually vested, the exit tax system works such that you will be deemed vested. And the market value of those shares on that day is what's going to be included in your exit tax return when you do tax clearance. So it is slightly difficult it is very difficult because of the fact that Australia is taxable on worldwide income and has a number of anti-avoidance rules, which mean that having foreign investment companies isn't the end. It doesn't actually work. Another example, I met a Singaporean financial advisor yesterday in the office, and he had a prospective client whose sadly husband passed away, inherited a big amount of money, but lives in Melbourne, approached this gentleman and said, "Can I give you all the money and you manage it in Singapore and it'll be..." And I said, "Well, no, work that way, because of worldwide income, because of all the other issues with respects to anti-avoidance, TFC, etc." So it's not a simple solution, but I think the key element to remember is that when you go back to Australia, whatever asset you take back, capital assets you take back to you that you've acquired whilst you've been a non-resident, for capital gains purposes, they will take on the market value on the day you return to Australia. So, using the example of I've bought 10% of my mate's startup in Singapore. I paid $100,000 for it. It's booming. It's now worth $1 million. Well, when you go back to Australia for CGT purposes, your cost base is $1 million, not $100,000, right? So there is some benefit in doing that, but it's obviously not zero, right? And it would be very difficult to avoid that just by sheer basis of how the Australian tax system is structured and set up.
Right. Certainly a lot to consider, and I'm sure there might be a few people listening to this podcast who've told the family to stop packing the bags, and maybe quite a few who've decided to start. But I think you highlight that it's about a lot more than just considering the bottom line tax rate in each country. Maybe as a final let's call it passing words, or final little gold nugget, if there's one thing you could share, perhaps with the entrepreneurial business owner community, whether they be in Australia or somewhere else around the world, but as Australians thinking about maybe starting a business in Singapore or expanding in Singapore, what's that sort of one piece of advice that you would share?
Find the right partner to join you on the journey. I said it right at the start of this podcast. Finding the right local advisor in Singapore who will not only answer your questions, but give you the advice or give you more guidance than you think you need, and knows the street, how the street works. That's going to be fundamental to making a success of your entrepreneurial journey. Don't think about, if you're serious about what you're doing, make that monetary financial investment to find that partner. Okay. There are a lot of service providers in Singapore that can do things very cheaply. Okay. Don't get me wrong, but the old saying of monkeys and peanuts, it's the same. Okay. And it can lead to a great deal more costs down the line, right? Go back to the GST example. Because the local firm which helped set up the company and was helping with the GST was not aware of the differences and the nuances between GST laws in Australia and Singapore. And not that really matters, they effectively broke the law, right? And this event was a very high profile event. So it wasn't a great, if it got out into the public, it wouldn't be a great look for this company on the first rodeo, so to speak, to have done this. So finding the right partner and someone who can then connect you with other professional service providers in Singapore, and if I think about a corporate approach, a lawyer, a migration specialist, a transfer pricing person, okay, and then for an individual, a financial planner, a relocation specialist, finding someone that has gone on that journey and understands what you are about to embark on is certainly a priceless and valuable asset that you're going to have.
Completely agree. And I said this to a new client last night. When you're moving to Singapore, if you ask 10 people a question, eventually you'll get the answer that you want to hear, but it won't necessarily be the right one. And whether they're
Absolutely.
cheap or just incompetent, you need to be very careful. And I know, Ben, you've worked with a number of our clients over the years. The feedback's always been fantastic. So, absolutely delighted to continue doing business with you and the team. Always very grateful for your expertise. And to be honest, hugely grateful for you giving us your time today. A lot of wisdom, a lot of gold in there, I think, for the community. A lot of business owners who might be thinking about making the move, who might already be here in Singapore and thinking, why on earth hasn't my advisor told me this stuff? Or might be in Hong Kong or elsewhere and thinking, hey, look, we need to think about Singapore as our sort of next footprint. So definitely reach out to Boon and the team at CST. Obviously, we'll pop the contact details in the notes. But yes, on behalf of Joel, myself, obviously our team, hugely grateful for your time, Boon. Yes, thank you very much.
Thank you, much. Great to talk to you both. Thank you.
Thank you, Boon. As mentioned in the first episode, we'll be releasing the podcast each month on the last Wednesday of the month. We'll be interviewing an expert each month on topics ranging from renting a house in Singapore, buying a house in Australia as an expat. The list goes on, and what investments can be working for you long term. The podcast is on all of our major podcast hosting services, so you'll be able to find us. Please like, subscribe, check out all other resources that we're generating and creating as part of this podcast. And of course, please leave us with your questions. We love to hear the questions. And if you want to hear a particular topic, or you know of someone that might be really good on our podcast, let us know, and we can definitely slide into their DMs and try and get them on board for you. So if this appeals to you, again, please like, subscribe, check out all of our socials. We're at MoneySideUp on Instagram, Facebook, LinkedIn, and Twitter, or X as known to. Jared, who have we got on for next month?
Next month, we've actually got a few experts lined up. So we've got a business expert exploring options throughout the UAE. So we'll be exploring a few things there. We'll be exploring relocation to that region as well. We've actually got quite a number of speakers lined up already for the second half of this year. Yes, plenty to unpack and plenty to dive into for what will no doubt be a very busy second half. But yes, if you would like to leave us a review, 5 stars, please let us know. If you thought it was crap, give us 2 or 3. If you thought it was really garbage, I'm surprised you waited this long and you're still listening.
Yeah.
But feel free to leave us with 1 star or let us know how we can make it better and of more value to you. But a huge thank you for giving us your time. I do genuinely hope you've got a lot of value out of this. And as Joel said, drop us a note with your questions. Feel free to shoot through any ideas. We look forward to seeing you in the next one.